Hello, everyone. I wish a very good and warm morning to one and all present here for joining today's book session under the lecture series, namely Academics and Beyond. Theme for this session is significant and germane to all who aspire to become tomorrow's entrepreneurs, financial analysts, investors, chartered accountants, and stock market players. So I guess it is important to all of you. Three words can define today's theme: raw material, processing, and output. Yes, you heard me correctly. Raw material is the information of financial statements. Processing is the analysis of this information of financial statements. And the output is interpretation and decision. So, what is financial statement analysis? Words put by Carlos Slim, Mexican business magnate who was once ranked richest in the world by Forbes, are quite apt. He says, with a good perspective on history, we can have a better understanding of the past and present and thus a clear vision of the future. Now, I would like to introduce today's guest speaker, CA Homesh Mulchandani. At present, he is practicing under the name of HR Mulchandani and Associates. He mainly practices in finance industry where he helps his clients to raise finance through various channels such as banking, NBFC and private equity. He is also engaged in management cum financing consulting assignments where he guides customers to plan, organize, and manage their working capital and long term funds smoothly and effectively. In early years, he has also served at Kotak Mahindra Bank in the capacity of chief manager for 6 years. Apart from professional serving, CA Homesh is a member of various committees of Ahmedabad branch of ICAI. He regularly keeps on writing on the topics of capital market and banking industries in the monthly newsletter of Ahmedabad branch of ICA. He is also a recipient of award Gems of Profession, an event organized by ICAI Ahmedabad branch. So we are quite fortunate to have with us such learned and experienced personality to share his knowledge with us. I invite this day's expert faculty, CA Homesh Mulchandani sir, to take over. Welcome, sir.
Thank you, madam. Thank you so much. First of all, good morning to everyone. So I am very much happy to share my experience on the topic. The madam said that the analysis of financial statement, and it's my privilege to share the insight how the financial analysis can be done. So the topic itself is a broader in terms, and as I have been informed by the madam that we are supposed to cover like the considering the management accounting point of view. So yes, madam, is my screen visible now? Okay.
It is visible, sir, properly.
Okay. Okay. So the topic is financial statement analysis. The topic, as I how the financial statement can be read upon and how the analysis is done, why it is required, why it is necessary to analyze the financial statement. So all those points we are going to cover in today's session. So let me start with the PPT. Okay, so first of all, I would like to speak upon the agenda which we are the topics which we are going to cover today. So the topic of today would be the first one is overview about the financial statement, like what are the financial statements, why the analysis of financial statement is required, and for whom it is useful, like who are going to analyze the financial statement. So all those points we will be covering up in the overview session. The second part would be what are the financial statement, what are the types or what are the parts of financial statement would be there. The third one, beneficiaries of financial statement, like, and how it is helpful for decision making, like who are going to be stakeholders of financial statement, and how it is going to be helpful in the decision making. The fourth one is tools and techniques of analysis. What are the techniques which we generally adopt to analyze the financial statement? How the financial analysis is done by at the various places. So all these points we are going to cover. Okay, next point is very much important, like the session in a manner which I have designed, like considering the time limit. So first 15 to 20 minutes we will be covering up all those points, like the quite of descriptive, and in the next part we would be talking about how the financial statement generally in practical scenario, how it is going to be analyzed from the point of view of banker or investor. Like as we can understand, mainly users of financial statements would be either banker or investor uh, uh, in a large manner. There are some other stakeholders as well, but we would be covering up the analysis point of view specifically from bankers and investors point of view. And
Sir,
the
sorry
last
to
one
interrupt.
yes madam.
Uh, Sir, the screen is very small, so could you just click F5 so that the screen becomes bigger? So the visibility will be better.
Correct, now is it okay?
Actually, all the slides are seen in the site, so you can close that one and just put the
Just
main slide. Yes, sir. I think you will have
just
to
a
share
minute,
the
sir.
slides again.
Just a
And
minute.
yeah, yeah.
Is it visible now, madam? Actually, I have already
Yes, yes, yes,
pressed
yes.
the.
It is visible now.
Yes. Is
Yeah, perfect.
okay. So shall I continue from the
Yes, sir.
point where we were? Okay.
Yeah.
So the last point we were talking about, that the this reading of financial statement from a banker's or investor's point of view, and the sixth one, I have some formats of financial statement which I would like to discuss with all of you. So how the financial statement, like from where we should start and how the analysis can be drawn upon. So all these points we are going to cover today. And one small request, we would be trying to keep this session more and more interactive. So if anyone has any question or any query, we can take in between the session, or as ma'am suggests, we can take at the end of the session. So, madam, as you guide, please.
Yes, sir. If there will be any questions, we'll take at the end only. Yeah?
Okay, no issues. Okay, so
Okay.
I am just starting with the first point.
Yes, sir.
Okay,
Yes, sir.
so we were talking about the overview of the financial statement. So first point, first of all, we would start with like what the financial statements are. So as we go with the definition, the financial statements are written records that convey business activity and financial activity of an enterprise. So, as we all understand, that the financial statements actually says about the business activity, the monetary activities we are doing in a business. Okay, the second point is what is analysis. As we are talking about the analysis of financial statement, we got the point that what are the financial statements, and like the monetary activities as we discussed. Now, what the analysis says. So, as again we go by the definition, the analysis is process of careful examination of the different parts or details of records. So, if we combine both the terminologies, so the financial statement analysis would be like It is a process of examination of various records and activities, rather financial activities of a particular business. It is what exactly analysis of financial statement can be framed upon. Now, the second point is types of financial statement. So, as we all know that there are certain parts of the financial statement, as we know, profit and loss account, balance sheet account, cash flow statement. There are many more like notes to accounts, audit report, and everything. But here, my point is, which I would draw your attention. In general parlance, we all know that what is the profit and loss account, what is the balance sheet. But actually, what the profit and loss account exactly is, anyone, if anyone can. Okay, I'm taking at my own. So as per my understanding, profit and loss account is the performance of any business. As we say, that is a profit and loss account. So profit and loss account states whatever the performance we have done, what the financial activities we have done during a particular period. So what exactly we performed, whether we made a loss or whether we made a profit, how much profit we have made, that is all about the profit and loss account. So in technical terminology, it is used to be said that profit and loss account is actually a performance statement of any business or of any enterprise. Now coming to the second point. Now what is the balance sheet? So balance sheet actually it is an uh, position of any business. As we discuss in the profit and loss account, like performance of any business, balance sheet would state that position of any business or any company or any enterprise. So these two statements are very much they have the importance from the analysis point of view. So as we can summarize, like profit and loss account is equal to performance of any business, balance sheet is equal to position of any business. Like in we will see in the sample format, like the profit and loss account and balance sheet, how it is how the entire analysis is done upon. But as of now, we can remember this point, that profit and loss account is the performance and balance sheet is the position. The third one, cash flow statement. So again, it is a liquidity position of an business. So generally these are the three statement which we refer from an analysis point of view or for any decision making point of view, where first two do have any like very much importance, and then cash flow and notes to accounts and schedules, everything would be there as the part of financial statement. Okay, the third point is beneficiaries, like who are stakeholders of a financial statement. So first we can see that shareholders, like owners themselves, owners analyze the financial statement just to ascertain, like the from analysis of the profit and loss account, owners can ascertain what exactly we have done during a particular period, whether we have made profits or loss, or how much profit is achieved, whether it is as per the expectation of the company at the time of investment. Like all the points of analysis is taken care into consideration from the owner's point of view. The second one is board of management again. So board of management and owners, like to have the better decision making, to have the better uh, company functioning. So shareholders and board of management do analysis of the financial statement. The third one and most important, and we are going to cover the third topic, third stakeholder today, that is the bankers or lenders or investors. So generally we see, if I talk about the practical scenario, so there are multiple companies registered in any city or an state or at a country level. So generally many of them are MSME customers. So it may happen that they might be a private limited company, or they might be a partnership or proprietorship firm. in most of the cases, like 90 to 95% cases, they generally want the bank loans or they generally want the investments. So in that scenario, analysis of financial statement is very much important, as they do need to interact with the bankers, and they need to convince the bankers or investors so as to invite them to invest in their companies. So the third topic is very much important, uh, uh, from a stakeholders point of view. The fourth one is government authorities. As we can understand, like in many of the cases, generally business can deal, like business does deal with the government authorities as well. Like they do have the government supplies, or they do have the procurement from the government authorities. In that case also, they are supposed to submit their financial statement, and analysis is done by the government authority whether to award any contract to any business or not. So government authorities are also one of the stakeholders where the analysis of financial statement takes place. The fifth one is other stakeholders like suppliers and customer. So generally, we see that where we are going to deal with the MNC companies, MNC suppliers or MNC customers. So MNC companies also demands for the financial statement of a business, so as to ascertain that whether they are really going to associate with the company of the respective company where whose financial statements are getting analyzed. So these are the broader categories of the stakeholders where the financial statements analysis of financial statement uh, is getting done. Okay, the fourth one is here I have just summarized the techniques of the analysis from a ratio analysis point of view, and there are broader categories, and in this subcategory there are different ratio analysis. Here it is mentioned from a descriptive point of view, but when we will jump into the this sample of financial statement, where we can actually reconnect what ratio states what. So here I am just taking the categories and subcategories. That the ratio analysis, there are mainly four categories. First one is the profitability ratios. So as we discussed about the analysis of a profit and loss account or the performance activity of a business. So in performance activity, there are certain ratio analysis. There are certain ratios which we generally measure, and based upon the ratio analysis, we generally take the decisions from a different stakeholders point of view. Like in the profitability category, so there is an GP and NP ratio, gross profit and net profit ratio. So what is the gross level margins are available in any particular business, what is the net margin available in the business, and based upon that, investors or bankers or even owners, they take decisions. The second one is EBITDA margin, that is the earning before interest and depreciation and tax. So EBITDA margin is also talking about the margin efficiency available in any business. So it is the before the depreciation and interest, whether the business is sustainable to get the sufficient margin so as to pay off these expenses, interest expenses, depreciation expenses, tax expenses. So EBITDA margin has also very much relevance in the analysis part. The last one is ROC. ROC is a return on capital. So from a owner's point of view, from a management point of view, so basically whatever the capital I am investing in the business, so do I get the sufficient margin? So here the concept of notional cost coming into picture. Like if I have any choice to invest in any business, so what would be my expected ROC, what would be my expected return on capital? So the analysis like would be like, what if I don't invest in the business and I put my money in somewhere else? So in the other option, whether I'm getting higher returns than the other option by investing in the company or by investing any business. So where this ROC ratio will be helpful. So coming to the second category, that is a solvency or gearing ratio. So here we are talking about the solvency of any business, of any company, whether the company is very much solvent or not. So in the solvency category, there are two ratios. So these are the ratios. There are multiple ratios which we are taking into consideration. But here I have mentioned the most useful ratios in practical scenario. So yes, we were at the solvency category. So first ratio is DE ratio, that is a debt equity ratio. Just because of size constraint, so as to summarize all the ratios in one PPT, so I have written the short forms. So the DE ratio is the debt equity ratio. So it is talking about like where bank giving a loan to any company. So they generally analyze this D ratio, whether whatever the debt company is having, so vis-a-vis equity or the promoter's contribution or business capital is sufficient compared to the debt. So there is a standard benchmark of D ratio as well. We will discuss later on. But D ratio basically is the debt equity ratio. The next one is the ISCR or DACR, that is the interest servicing coverage ratio and debt servicing coverage ratio. So this ratio is also generally used by the banks to analyze while giving the loans to the company. So again, it is linked with the profitability. So whether the company is able to serve the interest and debt obligation considering their profitability margins available in the business. So this ratio is very much helpful. Generally banks do take in analysis part. Okay, the third one is the liquidity ratio. Liquidity is the main heading, and under the liquidity, we have two ratios, that is the current ratio and the liquid ratio. So, again, current ratio is basically the difference of the current assets and current liabilities. So, current liabilities is under the denominated and it is divided by the current assets. So, the benchmark of this ratio is 1.33. So generally the business should have sufficient amount of assets as compared to their liability, current assets as compared to their current liability. And the next one is liquid ratio. So again, it is a sub part of the current ratio only. So in the liquid ratio, so whatever the current assets business have, that is very much liquid. So based upon that, liquid ratio is found out. And the last one is working capital, that is the asset turnover and working capital turnover. So basically these ratios are helpful to to find out the working capital cycle of the business. So asset turnover ratio is like whatever the asset business any manufacturing company has. So as compared to the asset investment, what are the turnover of the company? And the next one is working capital turnover ratio. Like what are your working capital cycle in terms of inventory holding, in terms of your credit period holding. So the working capital turnover ratio is also important one. So this is a brief about the ratio analysis. Like uh, these ratios are generally taken into consideration. Coming to the next point, so there is a second point of the analysis, that is a techniques of analysis, and that is a trends analysis. So here we have three categories. Trend analysis, we have an horizontal and vertical category. So basically it is used to derive the based upon, like in the uh, horizontal analysis. So we generally do take the base of any previous year, and considering the previous year's performance, we are expecting that company will be doing in the same manner, taking the base of a previous year's figures. And in the vertical trends, so basically we do take consideration the turnover as a base, and considering the turnover as a 100%, we generally derive the cost and the other expenses, like as to how much percentage of other cost are to the turnover ratio. So this is what the horizontal and vertical analysis. The second one is common size statement. So this is very much important while investment in the company. So basically, what we see, that common size statement, like if I'm investing in a company A, so I know there are multiple companies which are of a same size of company A. So I will take into consideration the performance and the other financial statement of other companies, so as to get the idea whether whatever the financial ratios or financial statement of company A says, whether is it is in line with the peers of that particular industry or that particular segment. So it is very much helpful while investing or while lending to the companies. Second one is the sorry third one is the comparative statement. So again, comparative statement, like we are taking the base of any respective year, and considering the base of a respective year, we are analyzing whether the trend is going in a smooth manner, or in a we can say that is in a positive manner, or like the taking the base of a last year, we are estimating the figures of the coming years. So this is what the other techniques are of analysis of the financial statement. Now we are coming to the samples of the financial statement. Madam, can I change my screen?
Yes, sir. Sure, sir.
Yeah. Okay, so this is what the we I have prepared one sample of the financial statement. So generally, it is an CMA data. So generally, banks ask for the CMA data, like if any company wants any loan from a bank. Okay, so before starting this financial statement analysis, I just want to give you the brief, like why I have selected the I have selected the analysis from a banker's point of view only. So what happens, that banks generally fund the business. Like if we are talking about the analysis, so when any financial institution, or when any investors invest in any company, that is why they want to check whether the financial statement of the companies are sound enough, so that they can put their money in the company. Like as a shareholder, let's say if I want to invest in any company, any listed company, so I can't put my money blindly, that someone has told me to put the money in the company, and I have done this. So analysis of financials is very much important before investing, or before putting my hard earned money into the company. So generally banks also does same thing before giving any loan. So generally there are various kind of loans banks give, considering the company's requirement, like it may be working capital requirement, or it may be capex requirement. So based upon that requirement, banks do the analysis. So as we were talking about that the sample of this statement, so here I have made the comparative analysis of any it is a sample format. So it is an income statement, like I have mentioned the figures of last 3 to 4 years. So first one is the income statement. So again, it is an income statement,
Sir,
but we would.
sorry to interrupt.
Yes,
The screen
yes,
has
madam.
not changed yet. The screen is still
Sorry,
the same. The screen has not changed.
just a minute, madam.
It is
No,
the
I
same
have.
one.
So, am I supposed to stop sharing and again
Yeah,
resharing
possibly.
the new
Yeah,
screen?
yeah, possibly. Yes, sir.
Okay, okay, just a minute. Sorry, madam. Madam, is this okay now,
Yes,
Kajal,
sir.
madam?
Yes, yes.
Okay, yes. Huh. So, we were okay. I'm starting from inception of this financial statement. So yes,
The
here it
figures,
is an
if
format.
the figures can be made a little big. because
Okay, yes, yes, sure, sure.
yeah,
Fair enough.
yeah, and you can close that upper. You can unpin that home
Just a minute.
through
Yes,
that.
yes.
Yeah, yes,
Okay.
yeah,
So we were talking about the CMA statement. Basically, CMA is the credit monitoring assessment. So generally, bank do the credit monitoring assessment while giving the loans to any company, any borrower. So this is a CMA statement where the like while starting the analysis. So bank does have any data, any figures of the past years. So based upon that past year, as we discuss in the comparative statement, so based upon the past year's figure, bank can foresee the futuristic approach of any business, and based upon that, they can derive on a conclusion whether to give a loan to any company or to the respective company or not. So this is what the statement is. So we are starting with the income statement. So income basically it is a performance statement, as we discuss in the profit and loss profit this the type of the financial statement. So here it is a performance statement of any company. So we are talking about that the sales of any company, let's say it is 1000 rupees lakhs. Then in 1920 it went to 1200 lakhs, then 14 and then 15. So bank can have the idea like what is the growth parameter, what is the percentage incremental growth in the turnover, and based upon that they can have their decision making. So these figures are illustrative, so as to get the basic idea. So here in the income statement, this is the sales, that is the revenue. Then we have the cost part. So let's say it is an this ABC Enterprise Private Limited is into the manufacturing activity, and these figures are designed accordingly. So the yes, we were at the material purchase. So on the cost part, there is an direct cost, that is the purchase of raw material and the processing cost. Then the next one is the other direct expenses like fuel, direct labor, and etc. So the third one is the change in the inventory. So here the figures are in minus. So let's say whatever the purchase I have made, so I have I have the inventory in my stock. So closing inventory is more than the opening inventory. That is why it is getting deducted in the total cost of the your purchase cost. So here we got the COGS, that is the cost of goods sold, and gross profit revenue. So the cost is deducted from sales, and we got the revenue. And here the other expenses like the general and administrative expenses, employee cost, and depreciation cost. And we got here the total operating expenses. Now, as we discuss in the EBITDA margin, like the earning before interest, depreciation, and the taxes. So my EBITDA would be 45 here. My EBITDA would be 63 here. So based on that analysis, any investor or any bank uh, can come to the conclusion like how the margins are sufficient, whether the margins are healthy or not in any business. So this is just an illustrative figures. We are coming to the analysis part. So then here it is an other income as well. Like the company does have any investment, and out of those investments they are earning any income. So this is a non-operating income. And here the interest expenses. So generally it is a most essential parameter, because from banks, whether the company is like the company is eligible to pay the interest cost on the loans. So the interest has to be like the profits has to be have the more than the interest cost. That is why any business or any company can mitigate the obligations of the interest and EMIs. So we will be covering up this point in ISER and DACR ratio. The total interest expense is here, and here we have the profit before tax and then taxes and then the net profit. So it is an income statement, performance statement of the company. Like we can say, like, out on the turnover of 1,000, company has earned the profit of 49 lakh rupees. 49 lakh rupees, yes, correct. So here is the profitability part, and the second one is the financial statement. Okay, so again, I have just put the figures of balance sheet part. Okay, so before jumping to the balance sheet part, so we generally see, like, in the balance sheet we do have the liability and asset, but in the financial terms, basically it is not the liability and asset. It is the sources of funds and it is the application of funds. Like, and how the balance sheet is designed, as we talk, that it is saying the position of any business. So position of what? Position of funds. Like, how much of amount of funds you have brought up into the business. So you may raise the funds from various sources, either own sources, or from outside loans, or from a free credit of your supplier. So the actual terminology is the sources of funds. And asset side, it is an application of funds. So whatever the funds you have raised, where those funds are getting applied. So that is how the analysis picture of a financial statement of a balance sheet is done. Like, what are the sources of funds and what are the application of funds. So as we have seen, that is the debt equity ratio. So that debt equity ratio is designed on the structure of your sources. Like, how much amount of equity you have, how much amount of debt you have, how much amount of outside liability you have, and based upon that your gearing ratios are ascertained. So this is just the income statement and financial statement. Income, profit and loss, and financial is the balance sheet. Now, the most important part is the financial analysis. So here we can see, like, it is a snapshot of the financial statement of your last 4 years. And what generally banks do, so based upon the performance of the 4 years, they can have the idea of the expected performance of the forthcoming years. And based on that, they decide whether whatever the loans we are giving to any company, or from an investor's point of view, whatever the amount of investment they do in the company, so are they going to get the desired amount of return or not. So that is why this analysis of financial statement is important. So yes, as we can see that the sales is from 1,000, it is 1,200, it is 1,400, and it is 1,500. So one can have an idea, like, the growth ratio. See, here we have a turnover growth ratio. So from 1819 to 1920, it is 20%. From 1920 to 2021, it is only 16%. Now we can have the justifications here, like, from 20% why it went down to the 16%, and again in the current financial year it went to 7%. So is there any sufficient justifications are available? uh, what would be the turnover of the next year, that is 20 to 23? So whether it is in line with the 7%, or again it further go down by than the 7% as well. So this is based upon the past year's financial. We can have the uh, we can have the idea of the future performances. And here the second point which I would like to cover, that is, like, the here we have got the EBITDA margin, the depreciation which we have put in the this second slide income statement, and here the cash profit. So generally I'm just giving you the brief idea, as we are talking about from the banker's point of view. So generally there are two types of loan. So one is a working capital loan, that is a cash credit and overdraft facility, and second one is the capex loan. So capex loan is to when any company desires to expand their business, and if they want the funding for, let's say, construction of your building or purchase of your machinery. So in that case, banks generally give the term loan facility. So what exactly term loan is? So it is a facility which are supposed to be repaid in a definite period, let's say 5 years, 10 years. So in that case, what generally banks do, like 10 years of facility they are giving. So based upon that, let's say 100 rupees is given for 10 years. So 10 rupees of obligation on an annual basis. So that means that company has to pay 10 rupees plus interest thereon annually. So, in that scenario, whether the profits are available enough so as to repay the 10 rupees of obligation. So, we have seen the ratio of IACR and DACR, that is the interest servicing coverage ratio and debt servicing coverage ratio. So, in that case, banks see that the interest and debt amount, whether the company is eligible to repay the amount of obligation, like the profit, whether the profit is sufficient so as to repay the amount of obligation. So here the analysis of IACR and DACR ratios come into picture, so as to this have an idea of the repayment capacity of the obligations. And the second facilities, I'm talking about the most prevailed facilities generally bank give. So we have discussed the term loan. The second one is the cash credit facility. It is a working capital facility. I would like to give some brief about the working capital facility. Like we can imagine, like any business, so as to run the business, they do need the funds for what? To purchase the inventory, to purchase the material, to pay off the creditors, or if they are selling the goods on the credit terms. Let's say I am selling my goods on a credit terms, and my money will be realized after 2 months or 3 months. So for that 2 months, 3 months, my capital would be blocked. So in that scenario, any business needs the funds for working capital management. So as to mitigate that problem, banks generally give the overdraft facility. Like what is the overdraft facility? Where the company can take the loan from a bank as and when it is required. Let's say bank has given me the sanction of 1 lakh rupees, 1 lakh rupees of limit. So I can use 1,000 rupees now. I can use 10,000 rupees tomorrow. So based upon my requirement, I'll be using that facility, but for the definite purposes. That is for inventory purchase, for paying off my creditors, or to run the expenses of my working capital. So here, what banks generally do, like they are seeing your working capital cycle, like whatever the turnover we are doing. Let's say here the turnover is 1,500 rupees, 1,500 lakhs for an year. So working capital cycle, like how much of days I am getting from my creditors, how much of days I am giving to my debtors as a credit period. So here, just a minute. So here it is in current ratio, like we have seen here. So my debtors amount is here, and this is my inventory. So I am telling my bank that 120 rupees is invested in the inventory. That I have purchased the inventory of rupees 120. That is on the particular date of the balance sheet. So what bank will see, like out of the 1,500 rupees of total turnover for an year, you have the inventory of 120 rupees. So like how much amount of days that inventory is getting circulated, that is 120 divided by 1,500. So it is 0.08%, and we have 360 days in a year. So roughly you have an 30 days of inventory on your hand, that is at any point of time throughout the year it is invested in the inventory. So based upon that, bank will derive your inventory cycle. And let's say I'm saying I'm giving the projection of 2000 for the next year. So what bank will see, that is at the 2000 your 30 days of inventory cycle. So so bank will see that the next year your inventory investment would be 170. So bank will give you the sanction based upon the projections you have given of your turnover. And based upon that turnover they will derive the amount of working capital requirement, that is inventory, creditors and debtors. And that is how the sanction limit is decided. So this second ratio is very much important, this working capital management as well. And we have covered the ISCR and DACR as well. Then profitability ratio, yes, it is also an important one. Okay, this is also an important one, that we were talking about the gearing ratio. That is the IBD and ATNW. So IBD is like interest bearing debt, and ATNW is like adjusted tangible net worth of a company. So in that case, what banks generally see, we were talking about the sources of funds, like how much of amount of equity would be there and how much amount of debt is permitted. So in general parlance it is permitted like 3 is to 1. Like if you have an 100 rupees of capital invested in the business, so bank can generally maximum, like bank can maximum go up to 300 rupees. So in that case, your ratio would be 3 70 300 rupees of bank's funding and 100 rupees of your own investment. So this is also this is IBD TNW is also one of the important ratio we generally we generally see while analyzing the financial statement. And current ratio, as we have talked about the working capital management cycle, so it is an current assets divided by current liability, uh, that is there. And ISCR DACR we have covered. What time we have left, Rajul madam? Rajul madam, madam, are you there?
Yeah, yeah. So 10 minutes more, sir.
Okay, correct. Madam, actually, I have covered all the important points from a
Okay.
ratio analysis point of view and comparative analysis. Now, if anyone does have any question, so we can open the stage for question answer or any discussion we have.
Yeah. Sir, one of the question is that what are the government guidelines for preparation of financial statements?
Okay, so there are as such no government guidelines here, but for financial statement preparation, okay, so the question is in terms of audit point of view or what? Sorry, I didn't get it. Or
Actually,
from
it
a
is,
bank's analysis point of
yeah.
view.
No, no, no. Like it is like from the viewpoint of Companies Act. Are there any
Okay,
new guidelines related to that?
okay, yes. So from a Companies Act point of view, yes, there are certain guidelines which are there in the Schedule 3. So based upon that, companies are required to prepare their financial statement. So the first and important point of the point is the proper disclosure of the financial statement and the in the notes to account.
Right, sir. Okay. Another, sir, question is how the company can maintain ideal capital structure because there are so many sources of funds. So, what would be the most ideal one?
Okay, we have discussed that point. The ideal one is like from even RBI says that like RBI has issued the directions to the banks while lending to the companies. So ideal structure is like the 3 is to 1. So if your total requirement in the business, let's say your working capital requirement or your capex requirement, let's say is 100 rupees, then out of the 100, promoter should bring the 20, at least 25 rupees in the business, so that the balance sheet or the business can't be overburdened. Let's say if my requirement is 100 rupees and I do have 10 rupees only, so I'll have to rely on the outsider like banks or the creditors for 90 rupees. So in if anything goes wrong, my liability would be higher, like 10 times higher than my own capital. So in that case,
Correct.
business getting into trouble, the chances would be higher. So the ideal structure can be 3 is to 1. Like whatever you design your requirement, if it comes to the 100 rupees, so at least 25 rupees of capital you will have to bring into the business.
Okay. Yeah. All right, sir. The one more question is there. What
Yes.
are the obstacles for companies while preparing the financial statements?
Okay,
What
nice
are the
question.
major obstacles? Yeah.
Yes, nice question. So I must say here the role of like chartered accountants come into the picture. So yes, obstacle. There are many obstacles. So as we can say that we have discussed the ratio analysis part. So there are certain benchmarks. Benchmarks are there. So while preparation of financial statement, generally companies do not have the idea about that benchmark. Like when they come to know on the basis of past financial statement where actually it got prepared, actually it got audited. When you are coming to the public for raising the money, or you are going to the bank for raising the money, then these obstacles, the questions are raised that this ratio is not as per the guideline, or this amount is not as per the guideline. So companies at the time of एक्चुअल रिक्वायरमेंट, सो अभी जैसे कि मेरे को कोई प्रॉब्लम है, मुझे जब तक पता नहीं चलेगा तब तक वो आइडिया नहीं आएगा। और मुझे वो प्रॉब्लम का आइडिया कब आता है, जब मेरा रिक्वायरमेंट कोई आता है तब। सो कंपनीज ऑल्सो लाइक देयर अकाउंट्स टीम और देयर चार्टर्ड अकाउंटेंट्स should should consider all those benchmarks before finalizing the statement. This
Right, sir.
problem
This
generally
is the
we face in the
practical problem.
MSME. Yeah. So generally this problem we face in the MSME customers. So what happens in the MSME customers? So they have the limited strength of staff and everything. So they generally can't afford to have the qualified team. So what happened? So they prepare the financial statement based upon the because their focus is to grow the business only.
Right.
In MSME customer, they generally want to do their business. Financial statement, हाँ ठीक है, वो तो audit हो जाएगा, देखा जाएगा. But these problems actually raised while they they are coming up with any requirement, and उस time पे these points are uh, these points are getting raised कि इसमें
Yeah,
ये
that
रेशो
is
ठीक
why
नहीं है, इसमें
31st March is something very crucial for all the
yes,
CEOs.
correct. So each and nowadays even we generally see that SME customers also, they are like slowly and gradually they are also becoming aware about their financial statement, because आज की तारीख में if we talk about like 5% of maximum 5% of companies would be there who do not require any finance facility. सो अगर आपको कोई फाइनेंस का रिक्वायरमेंट है, सो यू विल हैव टू गो टू दी पब्लिक। आपको या तो किसी प्राइवेट इन्वेस्टर के पास जाना पड़ेगा, और एल्स यू विल हैव टू गो टू द बैंक। सो एट दैट पॉइंट ऑफ टाइम दिस एनालिसिस ऑफ स्टेटमेंट एंड रेशियोज, सो वो बोले हमको तो पता ही नहीं है ये चीज़।
Right, right,
Generally it happens. So I'm sharing the practical problems which we generally as a consultant we are facing.
right, sir. So, sir, after this, there are no more questions from the students. So, I think I will just thank you and propose the vote of thanks and close the session.
Yes.
Thank you so much, sir, for explaining all the concepts in such a simple and lucid yet interesting way. You took a practical example and explained what all ratios are important. You put the ratios in the statement horizontally and vertically. You explained all of those. I'm sure everyone would agree that the session was quite engaging and knowledge enhancing. Thank you once again. On behalf of SMPIG,
Thank you.
I appreciate that you could take out time for conducting this session. I thank Anjali ma'am for extending the technological assistance. I also thank all the students who joined for this knowledge refreshment session. Thank you all and wish you a happy day ahead. Thank you
Thank
so
you,
much,
madam.
sir.
Thank you.
Thank you.
Thank you, madam. Thank you. So, can I stop the session now?
Yes, sir.
Yes. Yes. Thank you, madam.